Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here for tastylive, in San Francisco, as you can see from behind me. And we have a interesting set of numbers to share with you here today. We haven't had a lot of big U.S. Economic data since, of course, Friday's NFP, and since we're starting a week here after the holiday with quite a lot of global markets still closed, and the U.S. really just kind of waking up from the closures. Liquidity still very light, and the data reporting very thin, but we are looking at an interesting set of figures that are going to kick us off for a relatively action-packed calendar this week that will be starting to come across the wires here this evening if you're on the U.S. side of things for your time zone. It'll be Tuesday a.m. in Europe and Asia. And I'm talking, of course, about Chinese inflation figures, which are very, very important here for the overall narrative that we are looking at. Very important for the dollar, very important for stocks, very important for the global economy, very important for the entire conversation that we're having across the asset universe. And what we'll do here is we'll look at what the expectations are. We'll look at why they are and what seems to be going into them, and then break down what this means. Because we are looking at, of course, something that is intimately tied, as we just said, into all kinds of strands of the global market story that we're watching here. So first, let's consider some stage setting. Here's what we're looking at. This is Chinese CPI. This is the headline year-on-year rate. You can see it's been coming in since September. We had a peak then. If you want to kind of consider a broad story, somewhere between July and September seems to be the peak. These things are rarely just one dot. And since then, you can see we've had an interesting sort of dynamic because, of course, in the period between the middle of 2022, which is where it looks like inflation has peaked, and now China abandoned zero COVID restrictions and reopened, which is something that you might expect would be inflationary because growth might have been expected to pick up. And what we're not seeing here yet are signs of that inflationary pickup. You can see the expectations call for the March number to be 1% year on year, unchanged from the prior February reading, which was itself the lowest since the beginning of last year. So what's going on here and why are we not seeing it is one question. And the second one is, what would be the consequences if we did? We know, of course, that inflation has significant lag, that it takes time for the change in any economic policy, be it fiscal or monetary, to work its way into the economy and actually start to show up in headline figures. So if what we're seeing here isn't so much a disconnect and is more so a lag, what does this mean? That the second largest economy in the world might be gearing up for a bit more inflation. How does that register for the global economy as a whole? How does that register for U.S. stocks, for the dollar, and so forth? This is a study from a study that Bloomberg did. China doesn't actually publish its basket breakdown for CPI. So this is an estimate that was broken down by Bloomberg, looking at National Bureau of Statistics data from China. And you can see here the two big pieces of Chinese CPI are food and housing. So this is very much something that's driven domestically, which is very important to consider here. This is not something that is in large part influenced by the end demand part of where China sits in the global supply chain. This is driven by the front part, and I'll break down what that means in just a second. Let's consider what China is as a cog in the global economic machine, and of course, a huge cog. One might say the second largest cog after the US one. What we're seeing in that setup is basically a framework where, for decades now, the business motto in China has been import, import, import when it comes to raw materials, when it comes to food, when it comes to soft commodities, food, of course, a follow-on from that as well, because we're talking about fertilizer, we're talking about grains, etc., meat, milk powder, all these things. Import energy, import metals and ores, and export finished goods or intermediate goods on their way to being finished, but goods that have been transformed from their raw state, from raw inputs, into some kind of either finished or semi-finished item that nevertheless has had a good bit of value added. That value add coming from abundant labor. The resource that China has effectively been selling to the world has been affordable, abundant labor. And so when we talk about how the Chinese economy works and sort of the role that it occupies in the global economy, what we're essentially talking about is the connective tissue between raw materials producers and manufacturers and consumers in the developed economy world. And what we see here then is, we are of course looking at consumer price inflation, that the main drivers of it are on the part of this story that starts with imports and then goes to economic vigor and development, because of course housing speaks directly to, first of all, the capacity to buy, the capacity to live in cities, and so speaks to housing supply and so forth. So let's look at those two big components, because of course essentially they account for nearly half of this entire pie, over 40%, and see what that tells us about what's going on with this economy as it sits in the middle of this global supply chain through the various things that we're watching impacting inflation and impacting the policy response to it, and then of course the response from assets that follows. First, let's consider food. So therein, you can see marked on the chart is December of last year. That's where you get the reopening from COVID. And you can see that there's an initial pop there, both in year-on-year food as well as overall inflation prices. What you see much earlier is the slide, well, topping and slide in CPI excluding food. So if you take food out of the picture completely, what you see is a situation where it's food that's been at the driving side of all of this most recently. It was the decline in food prices that gave us the move lower, starting from, let's call it, the middle of last year. It was food that was the driver when we came out of the lockdowns. And of course, most recently, it was food that then fell off, and overall CPI skidded to 1%. That seems to be the main catalyst. Now, of course, overall CPI excluding food isn't helping, but it's been moving lower this entire time, from the sort of relatively early days of the second half of last year. That peaked in June. So, and of course, that peak in June follows a period of stasis, and so the real kind of decline starts in June, but the peak, one might argue, was all the way back in November of 2021. So we're looking at seemingly a CPI situation that's food-inspired recently. If we consider then what that looks like, and here we've lagged CPI by 5 months and looked at what is the inflation that China might be importing. And you can see here that the dark line is soft commodities, so food and food adjacent things, essentially, a proxy for that. And energy, which is the other big commodity that China imports to power all of this. And what you can see is that both food and energy prices were going down, but just about 5 months ago, there seemed to be something of a shift. You can see that coming out of COVID, the early parts of 2020, food and energy were going up at the same time. Energy had, of course, a bit of a accelerated run, and you can see it contributing there on the way up from November 21 onward. And then you can see the peak in early 2022 for both commodity indices. And now something of a switch, where energy prices over the past 5 months have continued going higher, but food, this critical component of Chinese CPI, which again, let's go back here, accounts for almost 20% of the total, which you can see here has been formative in shaping where things are going, that is actually starting to head higher and is near the highs going back to the middle of last year. This seems to suggest that we might be looking at some more upside pressure on Chinese inflation. That's food. Let's look at housing. Housing, you can see, is an even bigger component. Let's go back here again. This, a 23% component. Here's housing. What you're looking at here is HPI, which is the Housing Price Index diffusion gauge. This works in the logic of PMIs. So over 50 is expansion, under 50 is contraction. And you can see here, not only have we on that index surged past 50, we've surged past 70. So we're seeing a very brisk pickup in growth here, seemingly. The average house price index is lagged. It tends to go slower than official numbers on HPI just because of the way that it's reported. And because China doesn't really report a single number, it reports individual numbers for all the main cities. So what we're doing here is looking at a 7-city average. And you can see that lagged by about 5 months here. Seems to have a fairly good approximation of the HPI index, and seems to suggest that to the extent that this is a contributor of 20+% of CPI, we are again perhaps on the cusp of a move higher. That HPI index suggests that we are looking at a pricing story that is going to start showing up in average house price growth rates here in the relatively near term. And which is, again, going to be a positive contributor, ostensibly, to CPI, along with what we just saw on the food side of things. So, all in, it would seem to be that we're looking at what could constitute, if we get these forces registering in these numbers here, a meaningful upside surprise potential. The PMI numbers that we see, both official and private sector, do endorse this idea of a China that is primarily powered by domestic demand, which of course makes this CPI number and what we're looking at as its inputs that much more important. We just talked about China living basically in the middle of the global supply chain, and this part of it being the front part, where China imports mass amounts of things from the various economies supplying it. And then the back half being the manufacturing part, the part that exports into developed economies, both finished and intermediate goods. Well, what we see here from official PMI numbers is that the composite PMI index, which includes both services and manufacturing, is surging with services, while manufacturing is lagging. So it appears that what we're looking at is a consumer-led recovery in China, not so much a recovery that's powered by external demand, which may make the case that Chinese inflation could be somewhat contained, at least in terms of the export cost of the goods they ship abroad. Now, maybe this is a story of demand. Certainly could be the case. But nevertheless, what we see here is that what is important for China now seems to be the domestic story. You can see the same thing in spades with the private sector estimates of PMI numbers. These come from S&P Global in conjunction with Caixin. And here you can see that manufacturing is basically back to stalling. It's at the 50 line. It's neither growing nor shrinking, whereas services are surging, and the composite number is following along with services. That essentially it is domestic demand that is key. Now, we also see that Chinese economic data through the reopening, and again with a little bit of lag, has tended to impressively outperform relative to expectations. This is the Citi Economic Surprise Index that we like to look at across economies. This is the one for China. What it measures is the way that economic data performs relative to baseline forecasts that represent an average of economists' views that are aggregated by the likes of Bloomberg, Reuters, etc. And so what you see here when you see this index surging north of zero and climbing further and further higher is economic data is doing better than those baseline expectations had it, and by an increasingly significant margin, and that data is having an increasingly significant impact on markets. Something that is a very interesting feature of this index is that it scales the surprise quotient between expected and realized by how the market actually responds. And so the surprise index goes up more, in simple terms, if you get a positive number that the markets react to than a positive surprise that the markets don't, and vice versa. That it goes down harder if there's a downside surprise that the markets react to seeing as opposed to not. All this to say, we have had a lot of upward movement on this index. So it does seem to comport here that we should have more upward pressure on inflation, and that it should be domestic, and that it should come from things like food, and that it should come from things like housing, both of which seem to indicate that there is a bit more inflation in the pipeline than downbeat expectations of a 1% CPI number suggest. Now, maybe that's not this month. Maybe this shows up later. But looking at where we are time-wise in these indications, we're very close on the housing side. We seem to be lining up to around the area of a turn, seem to be rounding some kind of a bottom. And we appear to be right at that 5-month lag spot that would imply the handoff from energy to softs being correlated and then diverging right around now. So maybe not this month necessarily, but we certainly seem to be at the turning point or close to it for Chinese inflation, if this is what ends up being the dominant set of factors moving it forward. Now, why is this important? First of all, it is tremendously important in that it pulls on the various things that China imports. To the extent that soft commodities are being powered higher, they are becoming more expensive on global markets as a whole. If Chinese demand is in fact as robust as this chart would suggest domestically, then what it's doing is it's contributing to higher prices for all of those things that need to be imported to power this demand. And so it isn't necessarily energy, as we just saw. It's soft commodities. It's food. And so that, first of all, speaks to the likelihood that, for example, countries like New Zealand, which primarily export food to China, as relative to countries like Australia, which primarily export coal and iron ore, might have some difference in their performance. It also speaks to, of course, what those commodities underlying might perform like. And indeed, that's exactly what we're seeing in this index right here. That energy, so crude oil, natural gas, that those things are performing relatively worse than softs, like grains, say. And so that, of course, then speaks to the commodities mix everywhere else and speaks to inflation everywhere else. So to the extent that this becomes an ongoing narrative, we have a pull on commodities prices internationally, And to the extent that those commodity prices enter CPI calculations in the US, in Europe, in developed economies, all of which, of course, also have to eat and also import some amount of those foods or of those commodities that go into that calculus, we have a pull on inflation that then demands a response from the relevant central banks, be it the Fed, be it the ECB, be it the Bank of England, et cetera, et cetera. It also suggests that there's not a pull on those commodities like energy, like metals, that might power growth in an economy like in Australia, let's say, as we've just mentioned. And so maybe that central bank has less work to do in terms of continuing to hike rates. And of course, they've tellingly paused at their last meeting, and the Aussie dollar has been particularly soggy as relative to the greenback if we look at 6A futures. The other thing that's interesting here is that we could be seeing this narrative maturing. Notice that more recently, Chinese economic data hasn't so much fallen off as it's stalled a bit. And if we look at some higher frequency indications, we start to get a sense of a similar kind of idling. Here is metro traffic. This is a 20-day moving average across the top 5 biggest cities in China. You can see it surged well north of the median, albeit with some lag, as the reopening took hold, but now seems to have stalled. So perhaps the dividends of reopening, of people coming back out of lockdown, perhaps those have already been reaped. Perhaps we are already in something of a stasis. You get a similar view looking at the Shanghai Hong Kong Stock Connect total turnover numbers, and these are again a 20-day moving average. What this is the volumes transacted along a setup that essentially allows people with access to Hong Kong and listings there to buy and sell directly on mainland exchanges and vice versa. People that have access to Shanghai and mainland exchanges more generally to buy shares listed in Hong Kong. What this is essentially an outlet for Chinese investors to invest outside of the Chinese mainland, and an outlet for global investors to invest on the Chinese mainland. You'd think that the reopening would give us a burst of activity, but that's not what you see. The peak seems to be, tellingly, somewhere around the middle of 2021, right as the Fed really started to set us up for that rate hike cycle. With the December reopening, you got a bit of a lift going into it, perhaps anticipating it, as markets often do. Since then, we're not really going anywhere, and the most recent move here, a bit of an upswing, but very much within the range and near the top of that recent range that has basically prevailed for the better part of a year and a half. A little bit more even. So it could be that rather than looking at a pickup in Chinese inflation that necessarily gives us a story about reopening and its vigor, we could be looking at a situation where that front part is giving us higher costs. In other words, food costs, housing costs have been driven higher, but engagement with the Chinese economy on the other side, on the investing side, on the economic activity side isn't really coming in. And there is a disconnect between what it costs for China in terms of cost of living and what it's getting in terms of economic activity, a kind of stagflation sort of narrative, which of course would be tremendously impactful for the global economy as a whole. If we're getting toward a stagflation kind of environment, then what we're setting up for, and again, this is the world's second largest economy we're talking about here, what we're setting up for is a very curious possible policy response. If you choose to fight inflation in this kind of an environment, if in fact inflation comes in as seems to be the numbers foreshadowing here, well, then you move against what little growth you have. If you choose to focus on growth, well, then you drive up inflation and undermine significantly people's ability to pay their bills and to buy the necessities of life, because you undermine their purchasing power for those things. Most importantly, for housing and food. So altogether, you end up with a recipe for significant economic and perhaps even social instability in the world's second largest economy at a time when global tightening has raised the specter of recession, in particular in the US, but in developed markets as a whole. So if we're looking at a Chinese CPI number today, that because of the input side of the equation gives us a higher number than anticipated, but the other side, the output side of the equation, continues to look laggy or at least stalling, well, then we might very well be looking at a global recession that is faster coming, economic instability that is more acute, and a geopolitical picture that is more muddled even than it looks today. We have, of course, seen China attempt to make overtures both to Russia, but also to the West, attempting to normalize relations, attempting to open markets, attempting to do something on the output side that would get things moving bigger and faster. And so we could be, with just this CPI number ticking a little bit higher to reflect some of the forces at play here, be standing on the cusp of another big shock for the global economy that, frankly, doesn't seem like anybody's really pricing yet. And the kind of thing that could create a defensive dynamic broadly in markets that favors defensive assets like the dollar, like the yen, like bonds, and that registers painfully for stocks, registers painfully for growth-geared commodities and currencies, be it crude oil or copper or natural gas or the Australian dollar or the Canadian dollar. And so it's a very, very critical number that we're going to be watching today, given how everything around it is lining up. And of course, we'll see how the markets react. But the stage setting may well be telegraphing what we're going to come to know as a China stagflation story, let's call it, in a number of months, if the evidence lines up, needless to say. And that is macro money for today. Thanks very much for joining me. We're here Monday through Thursday every week, right after overtime with good friend of the show, Chris Vecchio, head of futures and Forex here at Tasty Live. I am also on with Chris on Fridays for Futures Power Hour and with Tom and Tony for First Call on Sundays. Thanks again, everybody, for joining me. We'll speak to you tomorrow. If you want to hear me opining outside of these shows, I'm on Twitter at Ilya Spivak. Good luck out there.